Well, finally, we've reached our last presentation with regard to mutual funds, investments for the masses. And in this final presentation, we'll discuss fund families. We'll take a look at some of the services that mutual funds offer and some of the sources for investigating and researching funds. And then finally, we will end with a discussion of a single mutual fund as a proxy for all 12,000 of them out there, and see that the news is good. If we have a long-term perspective, if we pick a mutual fund that has been around in good times and bad times, and we don't panic when the markets fall, as they invariably will. So let's get started on slide 62. A fund family exists when one investment company manages a group of mutual funds. Many decades ago, a mutual fund might have had just one or two mutual funds in their family. But then as competition started to accelerate, mutual fund companies started to introduce more and more mutual funds into the family. Funds in the family vary in their objectives, and you can move your money from one fund to another within the fund family, almost always with no charge. However, if it is in a taxable account, the IRS says, hey, you just moved from one type of investment to another type of investment. You're going to generate a taxable transaction, either a tax gain, a capital gain, or a capital loss, or depending on the type of fund. Now, as we said, there were some people committing things that really weren't illegal, but certainly unethical. So if you're in a fund family and you start moving from one fund to another, what some companies will do to discourage this is they will start charging you, in excess of transfer fee. 2% or whatever, or many funds will say, "Hey, that's it. You moved money out of this fund. You can't move it back into this fund for at least 30 days." Or they'll just say, "We don't want you anymore." Literally, there have been mutual funds that say, these are not trading vehicles. If you want to trade, go into the market and buy ETFs. No, mutual funds, open-end mutual funds, are long-term investments, and so. I wish I had said this, but a long time ago, Forbes said it best. Choose a family, not a fund. Because what some people will do is, it's a saying, they've never met a fund they didn't like. They see somebody on the telly or the infernal net say that this is a good fund, and so they buy that mutual fund. And then somebody else tells them, oh, this one's a good one. So they wind up with, a dozen or 17 or 20 mutual funds. Folks, you don't need... Mutual funds, by definition, are already very diversified. Now, assuming you are choosing a mutual fund that believes in diversification and is not concentrated in a single sector of the economy or a certain type of index that's just very, very narrow, yeah, you choose a family, not a fund. And here are the top 10 mutual fund families. Now, there's lots of text on the right-hand side, and if you're looking at this on your phone, you probably can't read that. But I'm going to read it for you. Various, source various. What does that mean? The problem is it's very difficult to get this information. The Investment Company Institute, ICI.org, is strangely silent about the size of the fund families out there. And I'm not sure why that is, probably something to do with politics. But let's read together. Various sources have the top 10 mutual fund families listed very differently. Some mistakenly count all assets under management, whether or not those assets are in a mutual fund. And so the biggest example is BlackRock. BlackRock is the number one largest money manager in the world, but they're not the number one mutual fund company. That's Vanguard. For this reason, the top 10 listed are essentially an amalgam of various top 10 lists floating about the info space. And as I said, interestingly enough, the one place you would expect to find the definitive data about this is conspicuously silent. That's the Investment Company Institute. So if you do start going around top 10, looking for top 10 mutual fund companies, and you find a definitive answer, please send it to me, okay? Because it isn't easy to find. But let's go through some of these, because they are, all of these, pretty darn good companies. Vanguard is certainly very popular now. They have convinced people that they're on your side. Folks, they're trying to make a buck like everybody else. And they were the ones that initiated, they weren't the only ones using it, but using indexing, but they're the ones who really made it popular. And that's how they become number one. And they will make noises like, oh, you don't want to have active management. Oh, investing passively using index funds is the only way to go. Well, if that's true, Vanguard, how come you still have Wellington Capital Management and PrimeCap in your list of mutual funds available? Yeah, but PrimeCap is one of the best mutual fund managers out there in the world. A group of people who spun off of the Capital Group, spun off of American funds back in the 1980s, early 1980s. And so if you can get a PrimeCap fund through Vanguard, congratulations. They're pretty darn good funds, but I think they closed most of them. BlackRock is, as we said, the number one largest money manager in the world, and they made their success in the mutual fund world with ETFs, the iShares. Fidelity used to be number one, and they have hundreds of funds. Fidelity's a very good company, folks. They have some dynamite funds, but they have a lot of stinkers, and my problem with them is that they're too many funds. In fact, if you go to their website, they're very smart in marketing, folks. You go to their website, not only can you buy Fidelity's mutual funds through their website and through their company, you can buy thousands of different companies' mutual funds. How do you like that? They want to be the one-stop center. Now, the next company is a bit of an enigma. They call themselves the Capital Group, and they've always been the Capital Group since 1931. But because they have funds like the Growth Fund of America and the American Balance Fund and the Income Fund of America, the Bond Fund of America, everybody started calling them the American Fund. So they said, oh, I guess we're the American funds. But now they're moving globally. So outside the United States, they really don't want to be known as the American funds. They want to be known as Capital Group. And they're changing their name here. Now, if they had asked me, which of course they didn't, I would say, look, don't change your name here in the United States. You're the American funds here in the United States. Outside the United States, you're the Capital Group. And other companies have done this. Panasonic is not Panasonic when you go to Japan. I think it's called Standard or something. So of course they're not asking me, and they make a whole lot more money than I do, so I'll keep my mouth shut. State Street Global Advisors is one of those companies, those trust companies, those banks that started out as custodians, and they still do that for many mutual fund companies, but they started their own mutual fund, mostly ETFs, exchange-traded funds, and have become very popular. T. Rowe Price is actually, by the way, Fidelity, Vanguard's based outside Philadelphia, BlackRock, I think they're in New York. Fidelity is started in Boston, and that was where many mutual fund companies were for many years. MFS, Putnam. American funds actually started in Los Angeles, but of course now these companies are global in nature. State Street, I think Boston. T. Rowe Price is Baltimore, and Mr. Price was one of the first, not the only one, but one of the first investors to go abroad, and they have some dynamite funds, so check out T. Rowe Price. Invesco is an amalgamation. The biggest part of Invesco used to be Oppenheimer, which was another storied mutual fund company that's based, I think, originally based in Denver, right? But again, they're global in nature. DFA, Dimensional Fund Advisors, is not a mutual fund company that most individuals gravitate to. They're very popular with investment advisors, with representatives, financial representatives. PIMCO, Pacific Investment Company, believe it or not, is based in Newport Beach. Very Tony address. And for the many years, they had the world's largest bond fund. But they have some very good funds. And then Franklin Templeton. We're going to discuss Sir John Templeton later on in the class. And Franklin Templeton Group is based, I think, in Northern California, right? But they have some dynamite funds. So what we're going to ask you to do, of course, is to check out a few funds. So if any of these companies pique your interest, check out their offerings. Or if you have a 401k at work, or maybe you have a Roth IRA, check out the mutual funds that are available through your employer-sponsored plan. And realize that there are dozens and dozens of other companies available. So in the face-to-face class, we would now stop and highlight many of the companies and their offerings. You're going to do that on your own. Check the website, check Canvas, and go through the lists and find that there are hundreds, thousands of mutual funds out there, folks. How do you choose? It's a very good question. Slide number 64. Let's spend a little bit of time and talk about why mutual funds have a wonderful attribute called the low PETA factor. Remember from the first presentation, PETA factor, pain in the... Well, because they have all these wonderful services. And the best service, in my humble opinion, is the automatic investment plan. Mutual fund service that allows shareholders to automatically send fixed amounts of money from their paychecks or their bank accounts into the funds. It has a name that we'll look at later on called dollar cost averaging. A really bad name, but it works so perfectly, folks. Pay yourself first. You might have heard that term. In my humble opinion, this is the absolute bestest way to invest in a mutual fund. You don't worry about whether or not it's a good time to invest. Every month is a good time to invest $50, $100 a month or more if you can afford it, right out of your paycheck or your checking account. And P.S., it is practically the only way that most of us working grunts are ever going to invest. You hear people say, well, I want to wait till I have $5,000 or $10,000 to... When are you going to have extra $5,000 lying around the house, right? Get started now. How much is your cell phone payment? When people say that to me, oh, I don't know if I have enough money. How much is your cell phone payment? Oh, it's usually about $80. Can you put that $80 into a mutual fund? Or maybe $50 or whatever. Yeah. And then the reinvestment plan is automatic now. It's the default. This is the service that enables shareholders to automatically buy additional shares in the fund through the reinvestment of dividends, interest, and capital gains. So by default, unless you say otherwise, they're going to automatically take any distributions, capital gains, dividends, interest, and they're going to reinvest them. You're going to buy more shares in the mutual fund. Automatic investment plans allow an investor to earn fully compounded rates of return. Unless the investor needs the income to live off of, it is always a good idea to reinvest dividends, capital gains received from the mutual fund. By the way, as we said, it is the default. Unless you say otherwise, they will do this automatically. Now, we, throughout the semester, are going to spend most of the time talking about accumulation. But what about when you're ready to take the money out? This is the best part, because with a systematic withdrawal plan, that enables shareholders to automatically receive a predetermined amount of money, usually monthly, quarterly, annually, but usually monthly. Normally, you set it up so that it is electronically transferred directly to your checking account. So here is the deal, dear students. You start putting $50, $100 a month away, you early folks, you folks in your 20s or maybe 30s or even a little later, maybe more if you can afford it. And then when you go to retire, when you're old like me, you can take $2,000 out a month or more, hopefully. Is that a deal? Automatically? What very cool things these mutual funds can be. The conversion privilege, the exchange privilege, we've already sort of made mention to that. Within the fund family, it allows shareholders to move money from one fund to another within the same family of funds without paying extra commissions or the like. But if it's not in a tax qualified account, retirement account, educational savings account, health savings account, you're going to trigger tax consequences. And at first, it's not going to be a big deal. The taxes are going to be very, very minimal until you have a very large amount in your account, and then congratulations. Slide 67. How do you purchase your mutual funds? Well, we've already made, again, mention of this. We've said that if you buy a closed-end fund, which are not as popular, ETFs, which are becoming very popular, through the stock exchange, you have to pay a commission unless you go with one of the mutual fund families like Vanguard, Fidelity, that says, okay, fine, buy your ETFs, our ETFs, through our website, and we won't charge you any commission. And if you say, well, I use Robinhood and I don't pay any commission, wait till next chapter when you realize you really are paying something. The open-end mutual funds you can buy through a broker, directly from the investment company, or the absolute bestest way, through your payroll, 401k, 403b, or your checking account. When you go to sell the mutual funds, closed-end ETFs, you have to do it through your broker. The open end, you can do it through a broker or directly through the mutual fund company. And the best way, in my humble opinion, is to have it automatically withdrawn every month, every quarter, whatever, into your checking account on the distribution phase of your investments. Now, taxes. We always kind of talk about taxes. We don't want to let taxes be the tail that wags the dog, but we need to keep in mind what's going on here with regard to taxes. There are two types of taxes for regular accounts: the dividends and the capital gains distributions. Now, it used to be that dividends were taxed at a higher rate than capital gains distributions, but now they're very similar. And typically, for most of us working grunts, they'll be 15%. Maybe less, maybe more, depending on how much what income bracket we're in. Reinvested dividends and capital gains are still taxable transactions. So save your year-end statements. With electronics now, they save them automatically forever and ever. But it's a good idea to hang on to them, tuck them away either electronically or via paper. And what happens? This is the dynamic. For example, 2022. You may have had a down year. You probably did if you were invested in stocks or bonds or both. And you get a 1099 in the beginning of 2023 that says you made so much and such much money, you have to pay taxes on these. Wait a minute, I lost money. How come I have to pay taxes? Well, even though the value of your investment went down, the company may have sold some shares at a gain, which means they pass through that gain to you, or you might have had dividends distributed to you. But you didn't see that money go in your pocket because they reinvested those dividends, those capital gains, back into your mutual fund. So you get this 1099 and you scream and holler at your congressperson, why am I getting taxed on something I didn't make any money on? Well, you did make money, but it was passed through, and of course the value of the shares went down, so they scream and holler to their congressperson who says, well, someday, we might set it up so that you only get taxed when you sell your shares and receive cash, and forget it's not going to happen. That would be such an incredible, disastrous mess of accounting that hopefully that never happens. Now, all this goes away if you put the money into your 401k or a Roth IRA. With most tax-deferred retirement accounts, you get a tax break now and you pay no taxes until retirement when all proceeds are taxed as income, whether they're capital gains or not. And that's why some people sometimes will say, well, you don't want to put money in a 401k because any capital gains are going to be taxed as income, and you'll have this big tax bill when you're in retirement, in which case I say congratulations. I hope all my students and my clients and myself all have that horrible situation where we're taking too much money out of our retirement accounts in retirement. Now, there's another type of way to put money into these tax qualified accounts, and that's the Roth method after taxes. And those are very cool. And we'll discuss these in detail later on at the end of the semester when we get to retirement accounts and regular accounts and the like. but you pay your taxes now, and then you don't pay any taxes when you retire. Very, very, very cool. And if you have any questions, don't want to wait until the end of the semester, contact me. I can talk about this stuff far longer than any reasonable person would ever want to listen. Taxes. Slide 69. Now, where do we go for the information? Well, in the face-to-face class, what we normally do is throw on the screen a prospectus, pass them around. They're really very useful, folks. If you have insomnia at night, pick up a mutual fund prospectus, start reading it, and I guarantee by page 2 or 3, you will be fast asleep. The prospectus is a statement describing the risk factors, the fund's past performance, describing the types of investments in the fund's portfolio, information about dividends, distributions, taxes, information about the fund's management, and nobody reads them. Unless, of course, they've taken BUS123, and we strongly urge you to download the prospectus for the mutual fund company that you're going to research and take a look at it. It's a lot of legalese, and it really is useful for insomnia. The easier piece of information is the mutual fund annual report. But again, some of these are pretty darn boring. In fact, now people get an email every year saying your prospectus and annual report are ready. Here, click here to look at it, and people just delete the email. They don't even bother reading it. Some companies used to spend a lot of resources making these annual reports look really, really slick, and they realize nobody's reading them, and it could save a lot of money simply by sending out an email that everyone deletes. So please do be the exception, and at least, for the mutual funds, we're asking you to go through 2 or 3 at the most. Do go through them and peruse the prospectus, read through the annual report. Some of them are quite good, dear students. Yes. Slide 70. How about financial publications? Well, you've heard of Business Week, Forbes, Kiplinger's, Personal Finance, Money Magazine. Morningstar and Lipper are the 2 major entities that do research on mutual funds. Lipper used to be the old staid. It was very expensive, and you went to the library. And then Morningstar came along and wanted to more popularize the world of mutual funds, and they've been met with much success. We have to be careful not to trivialize, and we applaud it. We applaud anyone who wants to make it easier for people to understand their investments. But at the same time, you have to be careful. And we saw a couple of presentations ago, we saw that style box took on a life of its own and kind of helped create all these thousands of different mutual funds. So check out Morningstar online. Realize that they're going to hit you up every 5 minutes to sign up for their $20 a month. Lipper didn't used to give you information online, but now they do to compete with Morningstar. And of course, the library. The library is a wonderful place to go, in my humble opinion. And you can get Morningstar and Lipper for free there. And then all these other magazines like Forbes and U.S. News and World Report and Barron's and all the other goody things that you can get at the library for free. These entities will create these surveys where they show you overall ratings compared to other funds and in the same category, the size, the sales charge, expense ratio. And I'm very reticent to put a whole lot of credence in these. I'm more interested in how well did they do over the last 5, 10, 20, 30 years. Not how well did they do last year, right? Because typically what happened, not typically, but it's so often what will happen is the mutual fund that was number 1 last year is number 4,783 next year. Because markets move in cycles, and if you're flying high one year, there's a good chance that the next year or two, you're going to be at the bottom. I like mutual funds that are sort of, drifting towards the top, but never reach the top, but at the same time, never sink to the bottom. And they're not easy to find in these surveys that, basically highlight the top 3 or whatever. So be careful, but do your research. One of the best places to go is the mutual funds internet sites, because when the internet was new at the late 90s and early 2000s, the fund companies started creating, gobs and gobs of information and good stuff. Vanguard had what they called the Vanguard Investing University. It was excellent. And Dodge and Cox and American Funds Capital Group and T. Rowe Price's website is good. Franklin Templeton's good. But then in the crash of 2000 to 2002, I think the Securities and Exchange Commission must have said, hey, you guys, cut it out. We don't want you doing this. I don't know why. I don't know what happened, but they all sort of disappeared for a while, and now they're back. So check them out. They all have these insights or market commentaries. Definitely check out Dodge and Cox and T. Rowe Price and Franklin Templeton and Vanguard and Capital. They're all very good, and they'll tell you. And they'll tell you what they believe is going to happen, and they'll also tell you, look, this is just forward. They call it forward-looking statements. They don't really know what's going to happen, but this is what we believe, and this is where we're investing and the like. And then the mother lode, as we said, ICI.org, the Investment Company Institute for people who love lots of data. Slide 72. Okay. Oh, are you exhausted, folks? I know. I apologize. This is part of mutual fund investing, is trying to get through, excuse me, all these thousands of different mutual funds. And so you might be ready to throw your hands up and say, okay, Payano, how do I pick a mutual fund? Well, it ain't easy. It's that deer in the headlights stare. Where do I start? And so here's my advice for what it's worth. You want to pick a mutual fund that invests in high quality stocks or bonds. Okay, quality is one of those words that it's kind of like love. It's very difficult to define, right? It's in the eyes of the beholder. And so you really have to make a decision about what you believe is high quality, but still you want companies that emphasize quality. Is well diversified across several industries and sectors of the economy. Well, that's fairly easy to ascertain. Okay, they have some of this, some of that, some of that. They don't have everything into technology or everything into energy. Has a long-term perspective and a manager, or better yet, in my humble opinion, a management team with many years of experience. The best mutual fund companies, in my humble opinion, have teams that work together. But what they do is they give their money managers latitude. It's not a committee. They don't all have to agree on the same investments. That's called death by committee. And let me tell you, folks, if you've ever worked in academia, you know what death by committee is. And so these companies have been around for decades, some of them, and they have teams. What you want to do is avoid companies that shuffle their managers every few years. Now, who was famous for this was Fidelity for decades. And even the guy who started Fidelity said, look, that's the way it is. After a few years, if they don't do well, boom, they're gone. Well, that's great when you wind up with people like Peter Lynch and Will Danoff in Fidelity, who are just absolute geniuses. And who was the other guy I can't remember his name now, my apologies. But it's bad when you get a stinker, right? It's not necessarily in the best interest of the investors, in my humble opinion. And now most companies don't do this anymore. Fidelity doesn't do this anymore. Most companies realize they need to give their managers plenty of time. They need to give them plenty of resources. And so this idea of the star manager, in and out, if you do well, congratulations. If not, you're out of here. That's disappearing, thankfully. And most importantly, you want to have a mutual fund that's been around for decades and performed consistently well in both good and bad markets. Don't tell me how well you did in a good market. Any idiot, your humble instructor included, can do well in a good market. There's an old saying, a rising tide lifts all boats. I want to know how well you did when the organic matter hit the ventilating device. And the corollary statement is, when the tide goes out, you can see who is swimming naked. So you want a mutual fund that has done well in good and bad markets, because it's those bad markets, as we've emphasized, we'll emphasize again, we don't want you to panic, because that's the worst possible time to sell. Ooh, is it too late to get out? When you hear people say that, it is usually too late to get out. Okay, so here is a sample mutual fund. Now, in the face-to-face class, we would now pass out some literature, show some things on the overhead projector. These ancillary commentaries and presentations are there for you in Canvas. They're there for you on the website. So check them out. You're going to look at the Investment Company of America. How's that for a generic name, right? Mutual fund, Investment Company of America. It is a mutual fund that's been around for 89 years. It's actually older than that. It actually started in the mid 20s, like 1926 or so. But it was taken over by a different company, starting with, I think it was December 31st, 1933, but they used January 1st, 1934 as their starting date. And it's a domestic stock growth and income fund. So remember, we talked about all the different types of categories. This one invests in stocks for growth and income dividends, and mostly invests in domestic companies. It's done almost 12%. Now remember, we said if you invest in stocks and you get 8, 9, 10%, you think you're lucky stars. And these people have done 12%. And so you're going to see a few different presentations. Stocks are very risky. Well, yes, in the short term, sure. But in the long term, no. Assuming that the world doesn't end. And you'll hear people say, well, now's not a good time to invest. Well, excuse me. When is it ever a good time to invest? People think it's a good time to invest when you hear people say, ooh, is it too late to get in? Yeah, that's usually the worst time to invest. The best time to invest is when people are saying, ooh, is it too late to get out? So there's another presentation that shows you what if you had invested on the worst day of the year over the past 20 years. Assuming you didn't panic, you did okay. And then there's a presentation that shows you the full 89-year history of this mutual fund. And you're going to see that, oh yeah, there are times when you've lost a lot of money. And as long as you didn't panic, it always has come back so far. But if it doesn't come back, what if the whole thing falls down and crashes and dissolves into a pool of tears, and there's no food at the grocery store, there's no gas at the gas station, no clothes at the mall, and the cell phones aren't working, and the trash isn't being picked up, and the garbage is strewn across the streets, and the sewers are backed up, and there's no energy, and failure is not an option. I'm firmly convinced, I've told you, that the next 20, 30 years are going to be the most prosperous years in the history of the world, of our civilization, assuming we don't blow ourselves up, which is a distinct possibility these days, die in our own waste, tsunami, earthquake, meteorite, disco returning. I'm very optimistic. Yeah, we'll see. And then what about market downturns? Well, what about them? We've already said there's an intellectual part of investing and there's an emotional part of investing. The important thing to do when markets fall is to keep a long-term perspective and dollar cost average. Now, what is this silly term, dollar cost average? You'll see it with a hyphen, you'll see it without a hyphen. It's a horrible name, folks. I've racked my brain trying to come up with something better. Systematic investment plan, automatic investment plan, I don't know. Dollar cost averaging is a system of buying an investment at regular intervals with a fixed dollar amount. Could you say that in plain English? Yeah, $50 a month, $100 a month. Yeah, that's what we're talking about. Practically the only way most of us will ever do our investing is through our paycheck or through a checking account automatically. Pay yourself first. You see, the cool thing about dollar cost averaging, and I took me a while to convince my wife because she was terrified of stocks. Uh, with dollar cost averaging, there is always good news. When you wake up in the morning, there is good news. The market's up. Good news. Yippee. Your account is worth more. Your $100 is now worth $100.22. The market's down. Good news. What? What are you talking about? No. Think. Next month, you will get more shares at a lower price when the $50 or $100 comes out of your paycheck or checking account. When do you want to buy things? When they're on sale, right? Now, you're not going to always buy at the highest part. You're not going to buy at the lowest part. And dollar cost averaging is not going to turn a lousy investment into a profit. It's not a guarantee. But here's something we hope you remember, and we're going to ask you to memorize it later on in the semester. Your average cost per share should be lower than your average price per share. Think about it for a while, and if not, forget about it and come back to it later at about 12, 13 weeks into the semester. Because you're buying fewer shares when the prices are high and buying more shares when the prices are low. So dollar cost averaging is probably, in my humble opinion, the absolute easiest and best way for the vast majority of us to invest. Don't worry about when the best time to invest is. The best time to invest is when the next paycheck rolls around and the $50 comes out of your payroll and into your 401k. Or from your checking account into a Roth IRA, or into a regular account if you want. But the idea is take the emotions out of investing. Pay yourself first, and hopefully you've chosen a good mutual fund that has been around for decades and done well in good times and bad times. And taking a look at slide 75, the hypothetical illustrations. Now, these things, folks, are not a guarantee of the future. You're going to see all kinds of disclaimers saying, this is past results and not indicative, not a guarantee of future performance, whatever. It's got all these legalese that nobody reads. But these mutual fund hypotheticals are called hypothetical illustrations. The life insurance companies do the same things. They are examples of returns from either a lump sum or a stream. I love that term, stream of investment. That's dollar cost averaging at $50, $100 a month, or some kind of combination of both. Maybe you get a little inheritance or settlement from some accident or something like that, and then you decide, hey, I'm going to keep putting $50 a month away. They must be approved by the Securities and Exchange Commission and the Financial Industry Regulatory Authority, and can contain disclaimers about future versus past versus future performance. And so in the face-to-face class now, we would stop and show you some of the hypotheticals that are already on the class website. And of course, they're in Canvas, so check them out there. And you're going to see Investment Company of America for all of its 89-year history. And as we said, the news is pretty good. But how many people have 89 years time frame? Well, you young folks, who knows, what's going to happen. You're probably going to make it to 100. I hope for you. I don't know if I'm going to make it to 100. I certainly hope so. Well, we'll see. But we use $100 a month for 30 years. Then $100 a month for 40 years. And you see those extra 10 years. That's why we want to get you started in your 20s or early 30s. And then what happens if you do $100 a month for 40 years, but then every year increase it to $110. $10 an extra every month. 2 fewer trips to $5. I'm sorry, six Starbucks. Next year, 120. Next year after that, 130. And oh my goodness, unbelievable. The numbers just start getting very, very large because of the time value of money. You didn't probably do those exercises in chapter 1. That's okay. We didn't ask you to. We're doing them now with real life examples. Now, is it a guarantee of the future? No. And we also show you what happens when you get into your later 40s and 50s. You just don't have that same amount of time. So you got to put more money in. And even then, you don't get to take advantage of the time value of money. When you're young, time is on your side. When you get to be old like me, time is your enemy, that old devil. And then we show you what's going on in the world of assets under management and brokers with clients who have at least $500,000 to invest. And what if they paid the upfront fee using the Class A shares or paid the assets under management, wealth management fee, wrap account fee, whatever you want to call it, the advisor's annual fee. And we chose Fisher Investments, not to attack Fisher Investments, but they advertise. They don't want to talk to you unless you have $500,000 to invest, and they want to charge you 1.25% a year. Oh well. So check those out, dear students. It is illuminating, eye-opening, in my humble opinion. And as we've said, the news is good. I think so. I'm optimistic. Slide 76. Now, don't think I'm trying to sell you ICA. ICA is a great mutual fund. It's been around for almost 90 years. But there are others. All of these mutual funds, and my apologies if you're looking at this on your phone, you obviously can't read all these, but these are all mutual funds that have been around for over 50 years, and up until last year, they all did better than 10%. Now, because 2022 is a little tough year, a couple of them have dipped below 10%. But look at it, folks, 1967, 1950, 1965, 1930, the original Fidelity Fund, 1949, there's the Investment Company of America, 1934, there's the world's oldest mutual fund company, MFS. It's not their oldest fund, but it's one fund that's actually done pretty well since 1935. T. Rowe Price, look at that. It used until last year it was 13%. Now, forget Magellan, folks. My apologies. I really should take Magellan out of there. And the reason Magellan is hands above all the others is because of one gentleman by the name of Peter Lynch, who we'll come back to later on, who between 1977 and 1990 ran up 29% a year. Unbelievable. And then decided, this is too stressful. I've made enough money. I'm retiring. And I haven't heard anything from him lately. His book, One Up on Wall Street, is a phenomenal book that you want to read. It's in the bibliography, and we'll come back to him later. But look at all these. Now, am I saying you should go out and buy these funds? Not necessarily. Most of all these funds are domestic. There's a couple that are global, the Invesco Global and the Templeton Growth Fund. But and I think New Horizons is global. I need to read more about that. Yeah, New Horizons is global. But most of all these are domestic funds. And why is that? Just because they've been around more than 50 years. It wasn't until 1960s, 1970s that global funds started to become popular. So there are other funds that are just as good, have been around 30, 40 years or better. And if you're starting from a clean slate, when I talk to people, some people are worried about investing overseas, and I understand that. But most people, especially the young folks, understand that the world is global. There's some political blowback about that, darn foreigners. But no, the world is global. And so I recommend usually a global stock growth and income fund, whereas the one we looked at, ICA, is a domestic stock growth and income fund. But, we're splitting hairs here. Mutual funds, by definition, if they're well run, are already very diversified. And there are some people, like Jack Bogle of Vanguard, who's no longer with us, sadly, who said, don't bother investing outside the United States. You have everything you need by investing in the United States. I understand where he's coming from. I beg to differ, because some of the best companies in the world are based in the United States, and some of the best companies in the world in their industries are not based in the United States. So I want to personally give my money manager the flexibility to find the best company no matter where they are. Does that make sense? And again, we can get into arguments over these, and chocolate and vanilla, and some people like strawberry. But here they are, folks. Here are a couple of dozen of mutual funds that have been around for over 50 years, and have given their investors excellent investment results. Uh-huh. Now, slide 77. What about the investors? How did the investors do? Well, there's an industry saying, and it's true, it's been shown statistically, most mutual fund investors do worse than the mutual funds they invest in. Wait a minute. How can that be? How could the mutual fund investor do worse than the mutual fund they invest in? Well, folks, it's actually very easy. Many typical mutual fund investors buy high. Ooh, is it too late to get in? And then the market falls and then they sell low. Ooh, is it too late to get out? Look at this graph. Now, it's a little small. My apologies. You might want to take a look at it on your computer, not your phone. But here was the internet bubble. 2000. March of 2000 is when the bubble began to deflate. This is the yellow line, the actual returns from the stock market. The green or blue or whatever they are, gray lines are mutual fund inflows. So you see, after the market had gone in two directions, up and way up, people started putting tons of money into mutual funds, just as the market started to turn downward and downward and downward. And it wasn't until 2003 that people started taking their money out, just as the market turned around and went back up again. And then, like moths to a flame, they followed the inflows. The inflows followed the market up until 2008 when the market crashed. And we'll discuss the crash of 2008 in more detail. It wasn't a stock market crash, folks. I mean, it wasn't the stock market crashed, but it wasn't because of the stock market. It was because of the bond market, and the bonds specifically tied to the mortgages, tied to the way overvalued real estate. So don't blame the stock market for the crash of 2008 and 9, but it doesn't matter. The market crashed, and sure enough, after the market had fallen almost 50% or 50%, that's when people took their money out. You're not going to be one of them, right? Promise me. We don't want this to happen to you, because it happens to a lot of people, folks. And some of them have, 8, 10, 12 years of college, a PhD next to their name, whatever. Doctors and typically some of the worst investors. My experience has been some of the best investors are artists, believe that or not. And so here come the market comes roaring back in 2008, but then was bumpy for a while. And it wasn't until 2014 or 15 when people finally decided, okay, it's not so bad. Let's put some money in. And this is where we need you, dear students. We need some of you who are really good at teasing data out of mounds of data, because I'd love to. This thing ends around 2017 or so. We'd love to see how it's done this last year, 2022, 2023, and see, oh yes, that goes up to 2015. We'd love to see how people did last year. We know that in 2020, a lot of people dumped their mutual fund assets when COVID hit, only to see the market come roaring back when everybody realized that, you know what, the economy's not going to, civilization's not going to fall apart. A whole lot of people are going to die, but the investments are going to hang on pretty well. And that's exactly what happened. The market came roaring back. 2021 was a very good year. 2022 was a tough year. Well, because a lot of companies were way overvalued, but the ones that weren't way overvalued, we talked about the equity income, they went down, but nowhere near as much as the high-flying FANGs, Facebook, Amazon, Apple, Alphabet, that's Google, Netflix, and who else? Who else is in that group? And they're not the only ones. Roblox, Stitch Fix, Twilio, all these companies that were high flying and fell like craters. So you're not going to be one of these people, right? You're going to choose a mutual fund that's done well in good times and bad times. You're going to keep investing when the markets fall. You're not going to panic. Maybe put even a little bit more money in. And if the world doesn't end, you're going to do very well. Now 20, 30, 40 years ago, I'm for 20, 30, 40 years from now, I won't be around, but you younger folks will, statistically. And I want you to remember this. We want you to remember that you've been given the good news. So, no excuses. Slide 78. Bottom line on mutual funds. Choose a fund family, stick with them. Reevaluate them periodically. I don't know, once or twice a year is usually more than enough. But make changes judiciously and sparingly. You like that word, judiciously? I love that word. As you approach retirement, migrate from stock funds to bond funds. Don't give up on stocks entirely. We'll discuss this later on in the semester when we get to asset allocation and balanced funds and balanced portfolios. But dollar cost average, $50, $100 a month, whatever you can afford. For the most part, forget about them. Do not be one of the mutual fund investors that does worse than your mutual funds. Remember, mutual funds will bore you to wealth. And that, dear students, is our discussion of mutual funds, investments for the masses. Now, we really want you to internalize this information, especially the share classes, the fees, the types of mutual fund, the categories. So go back over and study this and be awesome. You are rising investment gurus. Your friends and family and coworkers are counting on you. It's a very important, weighty responsibility. You can't let them down because now, oh boy, dear students, we're ready to start our long march, our journey with regard to stocks, exciting stocks, sexy stocks, risky stocks. See you in our next chapter, Chapter 3, Introduction to Stocks. Thank you so much for being in our class. We are so proud of you.